Okay, in this video I'm going to be going over the changes that we recently made to the S&P Crusher. So it's going to be a comparison or an overview between the S&P Crusher V1 and the S&P Crusher V2. Essentially, the S&P Crusher V1 has traded live since October 2015, and I'm sorry, some of the components of it since October 2015, the options side of it since January 2016. The changes that we made to the S&P Crusher, there's really three major changes. We added the covered calls, we added the morning gap day trade, and then we also changed the ES weekly options to be an Iron Condor as opposed to either selling a call or selling a put. Now we sell both, and it's based more on a momentum algorithm. So I'll be talking about all these changes and how I think that the changes that were made are beneficial to the package. And so with that, let me go over the disclaimer. Okay, so first I would like to go over our disclaimer. We are not registered with the CFTC as a commodity trading advisor. We are what's called a third-party developer. We create algorithms and we license them for use on a personal computer through TradeStation, and they can also be auto-executed through NFA registered brokers. Keep in mind that trading futures and options involves substantial risk of loss. These algorithms are really not for everyone. They should be traded with risk capital only, in our opinion. And lastly, the data that we show, unless otherwise noted, is based on hypothetical back-tested models, and it does have certain limitations per the disclaimer here. So feel free to read this. You can pause the video and read it more carefully. The last comment I'll make is that the data is for educational purposes only. Again, because we're not registered, we do not control client accounts. And also, I guess I should mention that because we're not registered, the data that we show has not been audited by any government agencies. So just keep all that in mind as we go through the data in this video. We're going to be talking about performance. Again, that's based on hypothetical back-tested models. It does have limitations. At times we do mention the live returns on the website or in the video, and when we do, that is from live data and we note it as such. When we do that, just again keep in mind that past performance is not indicative of future results, and again, trading futures does involve risk of loss and is not for everyone. Alright, so first I'd like to talk about the strategies that did not change, with the exception of the names. So the original Crusher traded the BullFire. The name of that algorithm was changed to the momentum. The actual code is the same as what we've been using for over a year now. The P2 push-pull, we changed the name of that to the Treasury note, and again, that's the only change that we made. The breakout algorithm, we changed the name to the Breakout Day Trade, and again, no change except the name. And then the S3 breakdown was our short day trade algorithm. We only changed the name to the short day trade. No other change has been made to that algorithm. So these four algorithms are the same ones that the Crusher V1 has traded, and we left them in the package because we feel that they are legitimate algorithms, and we really could not find any major improvements to them in the most recent kind of walk forward reoptimization that we did. The push-pull is one that we are looking at a little bit closer. I'm running some optimizations on it now to see if we can get some of the drawdowns a little bit lower. But overall, these four algorithms we think are great algorithms. They've traded live for over a year now, and we didn't want to change them if we didn't feel like we had some legitimate changes that would be helpful. The breakdown short algorithm, I know that one has in particular underperformed, although since the market has been for the most part going higher, we never expect that one to do well in up moving markets. The last couple months it's done better as the market has sold off some, and so that's kind of reinforced our opinion that this algorithm does have a place in the suite of algorithms that we trade. It's mainly there to do well when the market goes lower in a bear market like we might have in '08. With that said, I'd like to talk about now the changes that were made. Alright, so as most of you are aware, we've been around for about 3 years now. So my company's been around. We've been developing algorithms that entire time and offering them to the public. The Crusher is one algorithm that one portfolio that we recently decided to update. We also updated the STY futures algorithm, and then we created 2 new portfolios called the Day Trader and the Bearish Trader. In this video, though, I am talking about the Crusher and the changes we made, so I'm going to focus on that. Just keep in mind that changes are made on occasion to the strategies that we trade. If we feel that we have an improvement that we can make to them, then we will make that improvement. We're usually pretty slow to making changes, mainly because we don't want to overreact to just 1 or 2 bad months. In this case, we felt that the changes were really good, and we wanted to add them as soon as possible. So the last 3 months, the majority of my R&D work has been on working on the changes that we're going to talk about. And keep in mind, there were a lot of other things that we looked at, and these 3 changes are the ones that kind of emerged out of probably over 20 things that we looked at. So keep that in mind as I go over the changes that were made. So the first strategy I'd like to talk about is the covered call. This is a new algorithm that trades with the momentum algorithm, although it doesn't have to trade with the momentum algorithm. So it can be traded independently, but if it does, then it's not a covered call. It's a short call that's being placed. But let me go ahead and look at the some of the charts, and I'll kind of show you what it's doing. So this is a chart of the BullFire / momentum algorithm. This is the algorithm that has not changed. But what I've done is we've added to it the covered calls. So every time the BullFire momentum algorithm gets in a trade, we also sell calls that are out of money. And so what happens is we get into the trade, we sell the calls that are out of money. The reason why this algorithm, in my opinion, helps is because if the BullFire is wrong and we take losses on the BullFire, then the calls that we sell more than likely are going to expire worthless, and we'll keep the premium collected. So it provides a buffer against the downside. When the market goes higher, we still take the trades on the momentum BullFire algorithm, and we still take the same trades. But as long as we don't close by Friday above the call that we sold, then we also are profitable on the call. So an example would be this last few weeks of trades. As you can see, the market was going higher, so the momentum algorithm had some winning trades. On this one, this was a Wednesday when we got into the BullFire, so we sold the 2170 call. And on Friday, this is where the S&P expired, and it was below our call that we sold. So we collected all the premium on the call, and we were still in the futures trade. So on Monday morning, you have a gap up, and we got out of the futures trade. So now the futures trade was profitable, the covered call was profitable. Then we get back into the BullFire, and we sell another call because now this is Monday. And so in this case, we sold the 2175 call. You can see that the BullFire took a gain on Tuesday, it got back in on Tuesday towards the close, and then got out of that trade on Thursday. And then Thursday it got back in, got out on this spike on Friday, and then the S&P finally closed right in here at about 2179.75. So the whole time that this BullFire was trading and taking profits, we were short this call. And so it does create a weird case where we might be long above the call, but because we take profits, we lock in those gains. And what really matters is for the call is where we expire on Friday. And so in this case, it did expire in the money, but not by a lot. it was about 4.75 points in the money, because our call was at 21.75 and it closed at 21.79.75. So this call was in the money by roughly 5 points, which is technically a loss. However, when we sell the call, we do collect premium, and so it gives us a buffer on top of the strike price. And on this one, I believe we collected about 4.5 points in premium, and so this trade on the call side was really break even. If you factor in commission, that it was a small loss, but then when you add in all the BullFire trades, this entire sequence was very profitable for us. So as this shows, if the market kind of steadily goes higher, it really just depends on where it closes Friday, but in general we will take profits hopefully on the BullFire momentum, and then by the time Friday comes, hopefully it closes below our strike and we take profits on the call that we sold. If the market sells off and we get stopped out of a momentum trade, then those losses are buffered more than likely, because the call will probably settle out of the money, and so we'll keep all the premium on that. So the only time this doesn't work as well is if you get a huge rally in the S&P, but it still doesn't work out horribly, because more than likely we will take profits on the futures, and because we're taking some profits on the futures, the call will kind of nullify those gains, but then we really won't have the losses, if that makes sense. But because we get in and out on the futures, there are times when this call is not going to be covered. However, it doesn't require extra margin, because that by definition means that we're not in the BullFire, and so we have the 5,000 available for the short naked call. But usually if that happens, it's for a short period of time, because once the momentum starts triggering, if it gets out, it almost always gets back in the same day. So it's pretty rare that we would be actually naked the call, but there could be some times when we are. Also remember that if we are out of the momentum but short the call, a lot of times we might be long the breakout day trade. And so if that's the case, then we are still covered, but it's covered from a different algorithm. So that's a real kind of high-level view of how the covered calls work, looking at some of the charts. What I want to do now is show you my master development Excel spreadsheet, and I'll kind of show you some numbers on how this helps. Okay, so what you're looking at here is my master development worksheet, and we don't share this with customers because it's a little bit messy, and this is what I use in kind of the R&D environment to see how these different algorithms help or hurt. But what I'd like to, so what you have here is you have the 7 trading strategies that we have. This swing trade BF, that's the momentum algorithm, and this BF covered call is the covered call. So let me just highlight these so that they kind of stick out. Because what I'm able to do is by modifying these numbers here, I can turn off or turn on any given algorithm, and it'll update all the performance reports. So I can kind of narrow down to see how each algorithm does. So right now the only algorithm enabled is the momentum, the swing trade BullFire. And you can see that on and if this was traded alone, it'd be probably traded on something like a $20,000 account. So I'm going to change the unit allocation to 20K. And you can see the monthly win rate, the average profit per year, or the average dollar gain per year, the average profit on a percent basis based on this 20K, average gain per month, average percent gain per month, the drawdown, and the total number of trades. So take a look at all these numbers, and I want you to pay attention to the average profit per year and also the maximum drawdown. Because what I want to show you is that when you add the covered calls to the BullFire, I want to show you how those change. So you can see that the average profit per year jumped up quite a bit. It almost doubled. And the drawdown actually went down. And you can see the total number of trades went up and some of the other data that changed. But it's usually kind of rare where you get that happen when because keep in mind I add a lot of different strategies over the course of time to this to see how they do. The only ones that are showing here are ones that I believe add to the portfolios that we trade. So usually you don't get what I just showed you. Usually when you add an algorithm, it will, if it's a good algorithm, it'll maybe bump up the average gain per year, and then either keep the drawdown the same or maybe make the drawdown a little bit bigger. In some cases it will go lower, but it's kind of rare when you get this kind of effect where if you trade the BullFire alone, the momentum algorithm, you have this, a gain of 43.95 per year, 22%, with a drawdown of negative 45% on a 20K account. And then you add the covered calls to that, and the drawdown goes lower, and that makes sense because when the momentum algorithm's taking losses, the covered calls offset those. And then the average profit per year, though, actually goes up as well. So when I first coded this, what I thought would happen is the average profit per year might kind of stay the same or go up a little bit. I did expect the drawdown to go lower, which it did. But to see the average profit actually jump up as much as it did, it really did surprise me. So that's why we added the covered call. Very simply because it lowers the drawdown and increases the gains. And keep in mind, this is all back-tested hypothetical, so there's a lot of disclaimers that I talked about at the beginning of the video that pertain to this. But I just wanted to show you how the covered calls add to the overall suite of algorithms, and that's why we added it. Okay, so now I'd like to talk about the morning gap day trade, which is a new day trade algorithm that we added. We actually added this algorithm to all 4 of the portfolios we trade. By the way, the covered call has been added to any portfolio that trades the BullFire momentum algorithm. But for the old ESTY futures people, they do have to let the auto execution brokers know if they want to add the covered call because it now trades options, and that's something that they weren't doing before. That's something that they do have to request with the auto execution broker. And shoot us an email if you have questions on that, and we can walk you through. The morning gap day trade, though, is the other new algorithm that has been added, and I would like to kind of show you that one now. And I actually just did a big video on this algorithm, so I'm not going to go into a lot of the details. I recommend you watch the video on the morning gap algorithm. But basically what this one does is goes short in the morning on strength. And so it's kind of a gap fade where we go short, but we're not filling the gap, so we don't get out when the gap is filled. We actually hold until either the target is hit or the stop is hit. This is a day trade, so it's a little bit lower risk, and this algorithm actually is a really good one. I mean, it has a high profit factor, 1.7, has a decent win rate, but the average gain per winning trade is about $450. The average loser is $358, and it wins more than it loses. So it gives us a pretty good average trade net profit of 100. The only negative is it's only got 142 trades in the back testing. And again, in the other video I did on the morning gap, I talk about this algorithm in depth, so I recommend you watch it if you want to know more about it. But what I really want to do is show you how this algorithm contributes using that master developer spreadsheet that I have. So what I'd like to do now is go ahead and add the other algorithms that are in the S&P Crusher. And so maybe I'll leave out the Iron Condor though, since we haven't talked about it yet. So what we have here is we have the Treasury note algorithm. That's the one that has not changed. We have the momentum algorithm, again, that has not changed. We have the covered call, which is the one that we added that I just talked about, and then the day trade long and the day trade short. This one here is the day trade gap short, or the morning gap algorithm, but if we change this allocation to 30,000 now, and again, I want to emphasize this is all based on the back-tested hypothetical data. Although some of it is walk forward, because some of these algorithms haven't been optimized for over a year, so some of them are not that. So basically, these two and these two here, the previous year of data that you see in this trade list is more of a walk forward, but we kind of go with the lowest common denominator and just, we just say that this is all back-tested hypothetical. So the morning gap day trade, you'll see here I don't have it enabled yet. So what we have so far is the unit allocation 70K. We have a pretty good monthly win rate. The average profit per year is at 55%. The max drawdown is 27%. Total number of trades 2,497. So when we add the gap short, I want to show you kind of what happens. Alright, so you'll see that the average profit per year does go up a little bit to 17K, which makes the percent to 58.62. You'll see that the drawdown also went a little bit lower, and that makes sense because this algorithm, this gap short, does the best when the market's going lower, and without this algorithm in there, the weight is a little bit to the upside, although that might not really be accurate because the Iron Condor is not in this one, so it probably is an even allocation. But when you add the gap short, what it does is it'll add to the previous drawdown, which would have probably been the market's going lower, and so we're taking some losses on maybe the momentum algorithm or maybe the day trade algorithms, but the long one. But when you add this gap short, it helps out the drawdown a little bit and then also increases. So it also is a really good algorithm, in my opinion, to add to the portfolios that we trade. Okay, so at this point we have the crusher, but we don't have the Iron Condor added yet, and so I would like to talk about that next. Alright, so far I've talked about the covered call. That's a new algorithm, trades at the momentum algorithm. I've talked about the morning gap, which is a new day trade. Morning gap has been added to not only the crusher but the ESTY, the day trade, and also the bearish trader. So this has been added to all four portfolios we trade. The Iron Condor is the other algorithm that we added, and it replaces the ES Weekly Options V2. So the ES Weekly Options V2 was traded in the S&P Crusher V1, and we felt that it was a really good algorithm. Sorry, I had to clear my throat there. We thought it was a really good algorithm, and it did really well, except that it had a couple bad trades. One on Brexit, where it sold some. Let's see, what did it do? It sold some calls the day after Brexit, and then the market had a huge rally, and so we took a pretty big loss on that, and so it kind of gave back a few of the gains that we had throughout the year up until then. This Iron Condor we feel is a much better algorithm than the ES Weekly Options, and the main reason why is because what we're doing is instead of selling either a call or a put on any given week, now what we do is we sell an Iron Condor. And what an Iron Condor is, for those of you that aren't familiar, I will be doing a video on the Iron Condor, but essentially what it does is it creates a bracket. We sell a call and we sell a put. We also buy a put that's deeper out of the money, and we buy a call that's deeper out of the money as well for kind of black swan protection. And what that does is it lets us collect twice the amount of premium, because we're collecting premium on the call side and the put side, and it doesn't really introduce a whole lot more risk. And the reason why is because the previous algorithm, the Weekly Options V2, what it did was it used an algorithm similar to the short day trade algorithm. So when you had a gap down with weakness, that algorithm would go short, and we would also sell a put. Sell a call. taking kind of a directional position in the options. But what tends to happen is, not all the time, a lot of time it'll keep selling off or it'll go sideways, but you do have a lot of times where you get these insane rallies that cause that algorithm to take some losses. By using the momentum algorithm and only selling both calls and puts, what it does is it only trades during periods of more relative calm. And so you can see, like when the market started selling off a few months ago, this algorithm was not selling any calls or puts, and so it didn't take any losses. And in particular, when some of the election chaos was going on, it did not place a trade throughout that period because the market had been going lower. So it kind of sits out and lets the other algorithms do their thing. And so what it does is, in periods of more relative calm or sideways moving markets, it'll automatically sell calls and puts and create these Iron Condor positions. So that allows us to collect twice the amount of premium. And the risk that it does introduce is, now we could be hit if the market either rallies hard or sells off hard, where before it was kind of a one-directional thing. So that's the only negative. But when we look at it, it looks to us like a really good improvement. And I can look at the last few weeks of trades to give you an example. So this was a few weeks ago. We sold the calls at 2160 and the puts at 2120. So if the S&P on Friday closed between these two strike prices, that's our best case scenario, where both expire worthless and we keep the premium on both. In this case, the market did rally a little bit and closed just in the money on the 2160 call. And so on the call leg, it was a very small loss, and it actually was a gain because the premium we collected gives us even more of a buffer. But the put was 100% profitable. So the net trade for this Iron Condor was positive. And then we can look at this one from last week and a similar thing. We would have liked for it to close kind of somewhere in here, but we were wrong, and it closed a little bit higher. It closed in the money on the call by 5 points, but we collected about 5 points when we sold the call. So this was a break-even trade on the call leg, but the put leg was full profit. So when you add them together, you have kind of break-even plus whatever you made on this one. So what that shows you is that it gives you a decent margin for error. We don't have to be 100% correct. We just need it to be within a range, along with some buffer on top of that range. So that's why I think this algorithm is quite a bit better, mainly because it collects twice the amount of premium. It doesn't require any extra margin, and it trades, instead of during extremely volatile periods and periods of relative calm, now it only trades during periods where the market is kind of steadily going higher or going sideways. And if the market's selling off really hard, more than likely this algorithm won't place any trades. And usually when the market sells off hard is when you get some of the big movements that could be in the wrong direction for your trade. So let me show you my master development again, and I'm going to add the Iron Condor into everything. And what you'll see is that I believe the maximum drawdown will tick higher, but our average gain per year will also go higher. So when I add back in the Iron Condor, now this is the complete S&P Crusher package, the V2. And you'll see that the average profit per year jumped up quite a bit. The drawdown did go up some, but it's still within the acceptable level of risk. And you might ask, well, the drawdown though bumped up, I'd rather have a lower drawdown and maybe not have as high a gains. That is definitely an option. So you know, we don't control your account. You can trade this package without the Iron Condor, and it just so happens that is what the ESTY futures package is. So, but the ESTY futures trades on a 20K allocation, so the drawdown is actually higher because it's a 20K. But if someone wanted to do a 30K allocation, on this portfolio but without the Iron Condor, they could definitely do that. And that's kind of what the back-tested results would look like. But I do want to talk about why we did add this to the crusher, the Iron Condor. And for that, let me go back to my slide deck. So this is the all 7 strategies, and keep in mind this is all back-tested. If you want to know what this is, then I recommend you watch our design methodology video where we talk about what all this is. But essentially what we've done is we have each algorithm listed, and you can ignore the unit size. That's for if you wanted to trade these algorithms alone. It's what each one, the unit size would be. But what this shows you is how each algorithm does based on what the market is doing. And we purposely divided the categories of the markets into 3 kind of equally distributed states. So either up, and this really should probably be called strong up. This one is called sideways, but it really should probably be called sideways / drifting higher. And then this one is down, and I think down is an appropriate name for that one, because basically what it means is in the backtesting from October 2003 until October 2016, 1/3 of the time throughout that kind of 13 years, the market closed down by 4 points or more. And so that's what this is. About 1/3 of the time it closed between down 4 points and up 30 points, the S&P. That's what our sideways is. And then up was another 1/3 of the time, and that's the S&P closing 30 points or higher. So what this shows you is that, and actually let me go to the next one where we have the crusher listed with the right unit size. So what this shows you is that the Iron Condor, in up moving markets, it averages 1,442, in sideways moving markets 1,097, and in down markets negative 195. And again, it's okay that some of these do bad in down markets. I mean, if we had a crystal ball and we knew the next month would be down, then we would definitely turn off these 2 algorithms, but we don't have a crystal ball. So instead what we do is we create algorithms for each market condition, and then when you add them all together, you have a portfolio that has, based on backtesting, an expectation to do well no matter what the market is doing. That's kind of what this is showing. But to get back to the Iron Condor, why we do believe it's a good algorithm and why we have it in the S&P crusher is because it does so well in sideways moving markets. And that was the intent of that algorithm. When we first rolled out the weekly options, we wanted to have an algorithm that would do good when the market goes sideways, that would do really good when it goes sideways. And so that's why we developed it. And the Iron Condor is just kind of the next step in that strategy that originally was the ES Weekly Options. What kind of surprised me is that it also does really good in up-moving markets. I really was not expecting that to be higher than the sideways. But again, the data, we let the data tell us what it wants to, and in this case, it does do well in up-moving markets, even though we're selling calls. I think the reason why is because in up-moving markets, this will trade every week, and so I think because it's trading more, it allows it to have more gains. In sideways moving markets, it'll also more than likely trade every week, but it's very possible that a couple of the weeks it might be on the sideline, and so I think that's why it's lower. But what we really care though is not about this up moving, is the sideways. And so by adding the Iron Condor, it gives us a really good algorithm for this, 1/3 of the time when we expect the S&P to close either down 4 points or up about 30 points. And while we're looking at this, we can look at the covered call again, where it does really good in sideways, and then also good in down markets, and then okay in up moving markets. So if you kind of combine the momentum in the covered call, then you'll see how the covered call really helps the momentum algorithm out. And then the last one is the morning gap day trade that we added, and you can see it does the best in down moving, but also okay in sideways, and pretty much break even in up moving markets. So this represents our S&P Crusher V2, and for people that are trading this on the auto execution brokers, these updates were automatically applied, and I think that summarizes what I wanted to talk about. So again, the purpose of this presentation, well, I guess I do have one more foil that I'll talk about real quick. This is just another graphical representation of what we're already looking at, where you have the strong up, the sideways, and the down. And it shows how each algorithm contributes. And so you can see the Iron Condor adds quite a bit to the up moving, but more importantly to the sideways, because we really wanted to try to get the sideways up. And then the other algorithms add as well. The covered call, which is the kind of light blue, and the morning gap is purple, and you can kind of barely see that. So I think that's all that I wanted to talk about. Again, the purpose of this presentation was not necessarily to go over the Crusher in depth. We do have a video that already does that. It was more to show the evolution of the Crusher V1 to the V2, why we made the changes that we made, and why we think that the Crusher V2 will do really well moving forward. We honestly feel that the changes that we made are going to be helpful. But just keep in mind that, as everyone knows, I mean, trading futures is definitely risky. There's no such thing as a holy grail trading system. The algorithms, they do not win every month. They'll take losing months. But overall, we believe in our methodology. We feel that we stack the odds in our favor, and we think that this change to the Crusher V2 is gonna help quite a bit, and definitely be a strong improvement to the Crusher V1. And you know, this is a lot of the work that I do as the lead developer, design engineer with algorithmic trading. Is I get in the lab and I look at improvements that we can make, potential new algorithms we could roll out, how I think they help the portfolios that we offer. Just keep in mind, we're not registered with the CFTC. We don't give personal advice. You know, it's up to you to look at the data that we present and decide if you think it's something that would fit into your investment goals. If you're confused by if it might or might not, I recommend you talk to a registered CTA or a financial advisor, and they can look at your the details of your strategies in more detail, and they should be able to look at the data that we provide and let you know what they think about it. Overall, like I said, we make changes occasionally to the algorithms, but we're usually very slow to making changes. Usually we do a re-optimization based on the walk forward is set at about once every year, and that's usually around February, March that we do that. These changes were rolled out before then, mainly because I spent about 3 months in the lab analyzing data, looking at how we could use covered calls and maybe changing some of the options algorithms, and then in the process of doing that also rolled out the morning gap, which is an algorithm that I've had for a while and that I've thought about for a while, and we just felt it was a good time to roll it out. So I think that summarizes it. Feel free to email us or call us if you have any questions, and thanks a lot for your time, and have a great day.